Welcome to this week's briefing. We are cutting straight through the noise to bring you the 10 market-moving stories that actually matter. Let's get right into it.
You know, the theme this week really is clarity through chaos. We've got inflation that's proving way stickier than anyone wanted. The Federal Reserve, they're fighting themselves completely boxed in. And geopolitics, well, it's not just some headline anymore. It's moving barrels of oil, it's moving bond yields, and it's moving entire stock indexes in real time.
So as we count down, I want you to keep 3 numbers front and center. At number 7, we've got a geopolitical flashpoint that could literally rewrite the entire playbook for every asset class. Then at number 4, there's an energy shock that's threatening to lock in higher inflation for good. And number 1, well, that's the big one, a massive regime shift that's set to redefine how wealth is built and lost through 2026.
Number 10. The first major pattern interrupt we're seeing is this. U.S. equities are just refusing to break, even with all this macro stress hanging over them. I mean, look at these S&P 500 closes. That's a swing of over 160 points in a single day. What that tells you is this is not some fundamentally calm market. No, this is a liquidity-driven one. The fact that headlines can whip the index around so much just shows you how fragile the underlying positioning really is.
Number 9.
Right now, the entire market is trading the path to that next Fed meeting on April 28th and 29th. After they held steady back in March, the Fed's options are getting narrower and narrower. So every single data point from now until then is a potential landmine. A hot inflation print means higher for longer is back on the table. Any sign of softness and suddenly hopes for cuts are revived. The bottom line is the Fed has very little room to surprise anyone right now.
Number 8. And speaking of inflation pressure, this is the signal you just cannot ignore. We're looking at producer prices here. These are the wholesale costs for businesses. Core PPI hit 3.9%. That's the biggest jump in 3 years. These are the upstream costs that, guess what, eventually bleed into what you and I pay for everything. This shows that the whole disinflation is a sure thing narrative is under some very serious pressure.
Number 7. Okay, this is the geopolitical shock that can redraw the entire macro map. The Strait of Hormuz. I want you to think of it as the main artery connecting a conflict zone directly to your portfolio. We're talking about the choke point for roughly 20% of the world's oil supply. So any disruption here, it isn't just about the price of crude oil. It forces a structural, fundamental change in how investors price risk, hitting everything from shipping costs to government bond yields.
Number 6. So you take that geopolitical risk we just talked about, and you combine it with those sticky inflation fears. What do you get? You get our next point, a stronger U.S. dollar and higher Treasury yields. It's a classic flight to safety. The dollar strengthens, while yields rise because the market demands a premium for taking on inflation risk. And the implication? This combination is like a boa constrictor on global liquidity. It squeezes emerging markets and puts intense pressure on anyone with significant debt.
Number 5.
All right, let's zoom out for a segment for a much bigger, longer-term structural story. The BRICS nations are continuing their quiet but very real push to create their own alternative trade and payment systems. Now look, this isn't about replacing the dollar overnight, it's not that dramatic. But it is a subtle and very real attempt to reduce their dependence on the dollar-based system, especially for settling huge trades in commodities and energy. And at the margins, that can slowly chip away at the structural demand for the dollar, which has massive long-term implications.
Number 4.
Okay, listen up. This is the don't miss moment. Energy is the fastest way geopolitics hits your wallet, period. With oil trading north of $100 a barrel, the entire narrative changes. A sustained price spike like this pushes inflation expectations higher, it keeps bond yields elevated, and it forces central banks to stay cautious. It is the classic poison pill for equities because it crushes profit margins and weakens valuation support all at the same time.
Number 3.
This quote right here perfectly captures the market's psychology right now. Traders are reacting to ceasefire narratives, not fundamental conviction. So when stocks rally just because oil drops for a moment and not because earnings are getting better, the market is just trading on a relief spike. We call this headline alpha, and it's where the news of the day totally overpowers the underlying economic reality. It leads to incredibly unstable and unpredictable markets.
Number 2.
And the second biggest story this week, the Fed's reality check. For a while, the central bank was fighting a pretty clean disinflation trend. Not anymore. Its real enemy now is stubborn, sticky inflation. With consumer prices at 2.4% and producer prices running even hotter, the Fed's ability to just swoop in and cut rates is severely limited. That means we are most likely looking at a prolonged hold on interest rates or, at best, a very, very shallow path to easing.
And number 1.
The single biggest story is the collision of all of these forces. The energy shock, the inflation, the geopolitics, and a Fed with its hands tied, all creating a brand new market regime. This is where the real wealth shift happens. The winners of the last cycle, they all relied on multiple expansion, right? Investors willing to pay more and more for each dollar of future earnings. That era is being replaced. The winners through 2026 will be the assets with real pricing power, with exposure to hard assets and energy, and with a relentless focus on cash flow and scarcity. The market is no longer just discounting future dreams, it's demanding stability right now.
And that brings us to the final, critical question you have to ask yourself. In a world where persistent inflation, geopolitical shocks, and higher rates are the new normal, which side are you on? Are you positioned for a world of scarcity, or are you still positioned for one of pure speculation?